Hello, my name is Sean McDermott. I'm the president of Summit Investment Advisors. Thank you for watching LPL's 2014 Financial Market Outlook. We've titled our presentation, The Investor's Almanac. A lot like the Farmer's Almanac, we want to be forecasting what conditions will be like for this upcoming year. The Farmer's Almanac used to forecast the weather and crop growing. What we're forecasting is the economy and what types of investments are going to grow over the year to come. A Farming Almanac is an annual publication containing a guide for the coming year and a forecast of the times and statistics of events and phenomena important to growing. Farmers' Almanacs have been a source of wisdom rooted in the core values of independence and simple living for American growers for over 200 years. In the LPL Financial Researchers Outlook 2014, the Investor's Almanac, we seek to provide a trusted guide to the coming year filled with a wealth of wisdom for investors. Many of you might remember the Farmer's Almanac when you're growing up in a rural community or farming community, and it was a great publication. And along with me, I brought the 2014 or 2013-2014 forecast from the Farmer's Almanac, and this was put together by Caleb Weatherby, who's been around for 200 years, by the way. He made this forecast August 25th of 2013 for the United States. So he said, what's in store for winter? The days of chivalry are back. For 2013-2014, we're forecasting a winter that will experience below average temperatures for about 2/3 of the nation. Precipitation-wise, with a combination of below normal temperatures and above normal precipitation, the stage will be set for the Midwest, Great Lakes, Central and North New England to receive lots of snow. And that's certainly what we're getting in Minnesota this year, below average temperatures and a lot of snow. Good news in all this is that Caleb says that we're in for early spring. So I hope that's the case. All right, let's get back to talking a little bit more about what our outlook is for this upcoming year. Our expectations are 3% growth for the economy. Where we're seeing the strength lying would be in the housing, oil and natural gas development, and manufacturing, along with an improving European condition and less government intervention in our economy. We'll go more into that in a few slides. We're expecting 10 to 15% growth on equity markets this year, and that's good news for everybody that has investments in stocks. And for bonds, unfortunate news is a flat return. And with the bond market, when we get into an increasing interest rate environment, and you probably remember this from Economics 101, you have that teeter-totter effect between interest rates and bonds. When we get rising interest rates, the bond prices go down. And that's primarily what we're facing right now. And so we'll have to talk about alternative ideas. So we're going to be going through where you should be sowing seeds in your investments, what types of investments you want to be adding to right now. We'll talk about those investments that are in full bloom. And then we'll look at investments that we think you should be harvesting at this time. And this report, which I'll be going through today, feel free to call or email our office, and we'll send you out the slides along with this report. We feel that there's going to be a long, cold winter in Washington this year, and that's a good thing when Washington, D.C. takes a back seat to the investment community. 2013 was driven by governmental policy and negative events, starting over in Europe with the Cyprus banking crisis, Greek debt market debt, European recession, Italy having no leadership for 3 months. You probably remember all those negative things going on early last year, 2013. Also in our own country, we had a lot of things going on like the tax increases, we had Obamacare, we had the fiscal debt ceiling debate, we had the sequester where state and federal governments closed down and people missed their checks and were traveling and couldn't get into the national parks and historic sites. It was a mess in 2013, and I'm glad that's beyond us. So what we think we're going to see for this next coming year is that we believe markets 2014 marks a return to a focus on the fundamentals of investing rather than reading the tea leaves in policy statements or assessing the veracity of politicians' threats. So basically, we're hoping that the market, that there's going to be less than smoke and mirrors coming out of Washington, and Congress will have less interaction in our economy. Now, one of the debates that came up early in 2014, which fortunately didn't raise a lot of problems, Congress voted 67-31 to raise the federal debt limit, allowing the government to borrow money to pay for government programs such as Social Security, federal salaries, and basically gave them the open checkbook all the way to March 15th of 2015. On February 15th, President Obama signed this into law. And so now the government is somewhat out of the picture until next year when it comes to the federal debt limit debate. So what should we do as investors? Well, we think that active investing is going to be very important to your portfolio. Active managers have tended to outperform the indexes when markets have been more volatile. So what do you mean by volatility? Well, when you're investing in equity investments or stock investments, and you look back in history, going back, according to research from Davis Research Institute, going back to 1928 through 2012, the market has actually had, on average, 5% corrections per year, and on average, 10% correction per year. Fortunate news is we haven't seen a 10% correction since the summer of 2012. So we feel the market is ripe. We have fertile soil for the green shoots of stronger growth. We find that LPL research forecasts economic growth as measured by real GDP to accelerate from 2% pace of recent years to 3% in 2014. This marks our first above average census annual forecast on GDP in many years. When you're looking at GDP growth, which is a measure of goods and services in our economy, and it has accelerated for the last couple of quarters. So in 2013, the third quarter GDP growth was actually at 4.1%, and the fourth quarter is at 3.2%. So having 3% GDP growth is not out of the ordinary. When you look back to after World War II, on average, our economy has grown at about 3% GDP growth. What we're looking at here is after World War II, all of the post-recession recoveries. On average, recoveries last for about 8 years, and presently we are 4.5 years into the recovery of our market. So we feel that we have a few more good years left of growth in our economy, and it's very unlikely at this point in time you can make an argument for a double dip recession. We feel that the government drag on the economy the government has given us a lot of drag on the economy in the past 3 years. Now, I think at this point in time, the government should be quiet for a while. And Mark Sandy, chief economist at Moody's Analytics, said the only thing that has to happen is that lawmakers have to do nothing. It's a pretty low bar that they have to follow at this point. And personally, I hope they follow it. We feel stocks have room to grow and produce solid gains. We believe there are going to be many driving factors as to why stocks will perform well this coming year, and let's talk about that next. We feel with long-term interest rates remaining historically low, corporate earnings are likely to grow in the high single digits. We think job growth will be improving and inflation will remain at 3%. Basically, conditionings are ripening for stocks to reward investors in the year 2014. Right now we're finding four factors that are driving the equity markets. The first one is the housing market. We're finding that new home permits are actually at a 5-year high, and existing homes for sale on the market have reached a 5-year low. So there's a lot of new building and development going on out there. Who benefits from this building and development? Well, companies like Home Depot. The banks profit quite a bit. Anybody that's in the home building industry, anybody that's supplying consumer goods to those homes like furnishings and electronics, the banks are doing well. And plus all the construction workers that are fully employed at this point in time out there in the economy earning and spending money. The other big factor is the oil and natural gas development going on in our country. In 2013, the United States was the #1 exporter of petroleum products in the world. That's a big turnaround from what it was like 5 years ago. So with the new hydraulic fracking and horizontal drilling methods, there's quite a bit of oil that has been discovered. One of the big oil deposits is in our neighboring state, North Dakota, where there's actually 7 billion barrels of oil under the ground, and that's more oil than Saudi Arabia has. And a couple examples of how this might be benefiting U.S. corporations and actually our local economy. I have a retired client that was a chemist at Ecolab Corporation, and he was telling me that for every 1 barrel of oil that comes out of the ground, it takes 4 barrels of fresh water that are pushed into the ground to get that oil to come out with the fracking method. Now when that water comes back out of the ground, it's considered to be pretty dirty. And so companies like Ecolab are out there finding solutions in order to clean the water that's coming back up from the fracking method. In addition to that, I recently had a client who retired from Xcel Energy, and he's back working for Xcel Energy as a consultant. And what he's doing is he's helping convert the coal-fired plants along with nuclear facilities into gas-fired facilities because there's such an abundance of natural gas, they say hundreds of years of supply. Now, there's a third factor, and that's what we're seeing as manufacturing is actually returning to the United States. And why is that? Well, because we have cheap energy here. When you look at energy costs on a per million BTU basis, it's basically $3 per million BTU for energy here in the United States. In Germany, it costs $9 per million BTU, and in China, we're looking at $14 per million BTU. So what does this equate to? Well, if you build a Volkswagen Passat over in Germany, it costs $8,000 more per vehicle than if you built it here in the United States. So a lot of the big automotive manufacturers are expanding their facilities here in the US, whether it's Toyota or Honda or Rolls-Royce or Mercedes, or even Maserati is building a plant in Detroit right now. And that means a lot more US jobs. So we're pretty excited about the housing, oil and natural gas development, and in addition to that, the manufacturing environment coming back here to the United States. So US stocks, we see above average total returns for US stocks and below average total returns for bonds. Now, sometimes after a really good year with the market, such as 2013, where the S&P 500 indexed averaged 29.6%, investors expect there to be a down year following. Now, as you see from this chart, in 2013, stocks averaged 25 to 30%. What we're finding, and historically speaking, that if stocks grew at a 25 to 30% range, the following year average gain has been 12%. And so a lot of times the market has momentum going into the following year with both economic growth as well as investors adding more to their equity portfolios. So what we oftentimes see is investors may have had a lower return in their fixed income or bond type investments and a higher return in their stock investments. So what they do at the end of the year, they look at it and they rebalance. They say, okay, well, let's put it into this investment that's gone up a lot, and they keep adding to that. And so in 2013, it was the first year in 5 years that equity mutual funds actually had positive cash flows, more money coming in than going out of them. Now, so that it's kind of reversed itself where more money is coming out of the bond markets and going into the equity markets. So how to invest? One of the areas that we think will be a good investment for 2014 is in cyclical stocks. We're finding that accelerating earnings growth and a steeper yield curve over the course of 2014 favors cyclical companies, regardless of growth or value style. So the question is, what is a cyclical company? Well, companies that are cyclical include car manufacturers, airlines, furniture retailers, clothing stores, hotels, and restaurants. So these are companies that do well when we have a good economy because people can afford to buy new cars, upgrade their home furnishings, go shopping, and travel. So a couple good examples of this. I recently had a client that came to my office and they said, Sean, you know, our funds have done well. We've been waiting to take that big trip to Alaska. So they actually took $10,000 out of their retirement so they could pay for their trip to Alaska this upcoming summer. Not a week goes by where we don't get a call from a client that's saying, oh, we need some money to purchase a new car because we've been holding off on this for a few years now. And right now they say the average car in the United States is 11 years old. And so there's a lot of people that are looking at replacing vehicles in the next few years here. And that's a really good thing for manufacturing and again for the cyclical stock companies. Another example of that is Delta Airlines recently paid out record level profit sharing to their employees. And of course, Delta sells a lot of airline tickets and a lot of more folks are traveling and going on vacations in the last 12 months than over the last 5 years. This next slide talks about reliable earnings indicator pointing to higher returns. And the important thing here is that we're in a good point in our business cycle. And again, you know, there's many factors that will be driving the stock forward, which we'd be happy to send you our full report on if you'd like to send us an email. Small cap stocks are another area that we feel will do well in this market environment. Historically, an environment of improving growth and rising valuation has tended to benefit smaller company stocks over their larger company peers. And so the small company stocks are a great place to be when we have a strong stock market. Historically, the small caps have outperformed large company stocks when we're in a bull market environment. Now, talking about a bull market environment, let's go on to this next slide here. Bull and bear markets back to the 1950s. So what we're looking at here is many times investors will go, okay, what happens when we get into a rising interest rate environment? What are stocks going to do? Are they going to underperform? Are they going to go down in value? Because a lot of folks think we're going to be in a rising interest rate environment. Well, I'm here to tell you that historically, in a rising interest rate environment, we'd have to go back basically to the 1950s, the decade in 1950s, and that most similarly represents where we're at right now, where we kind of have a flat yield curve, almost negative rates of return on cash because of inflation and taxes. Bonds, interest rates have been pretty flat, likely to go up. But as you see during the decade of the 1950s, stocks actually went up in value in a rising interest rate environment. And last summer, we saw a blip in the equity markets during the summer months. And it wasn't necessarily because because interest rates were going up. The problem that we saw last summer is that the Federal Reserve started to scale back on the QE3 bond buying program. They were buying $85 billion per month, and now they've reduced it down to $75 billion. And so that might be something that we have to watch for in the next couple of years, is when the QE3 is scaled back. And our belief is that the economy can stand on its own at this point in time, and it's probably a good time for the Federal Reserve to start reducing the amount of debt that it's buying back. How to invest? emerging market stocks. As 2014 matures, the stocks of companies in more emerging market countries may become increasingly attractive due to improving global growth and below average valuations. Also, we think international developed market stocks will be a strong sector. Better economic growth in developed foreign markets, notably Europe, should lift earnings growth. So with that said, if we think about the Callan chart of investment returns, you may recall the chart that goes back and shows all the different sectors of the market for the past 20 years and how some of the investment or an investment that is underperforming oftentimes becomes one of the better performers after being an underperformer the prior year. So what we're predicting or what we're thinking about is the valuations of international stocks and developing market stocks have been down, and so the price earnings ratios are fairly low right now. So we're saying, stay allocated to those sectors, if not even add more. Thank you. And our next speaker will be Joel Budd. Joel Budd is our next speaker. He's going to be talking about bonds and the bond market outlook for 2014. Joel.
Thank you, Sean. I'm going to spend a few minutes talking about bonds and what we forecast for 2014. Most of you have bonds in your portfolio, and a bond is much different than a stock. A stock is your ownership in a company, whereas a bond, you're actually borrowing a company money for a set period of time, hoping to get a good return over that period of time. What we see with bonds is an inverse relationship to the stock market. When stocks are up in value, bonds will tend to be lower in value. And over history, the opposite is held true in an inverse relationship, much like a teeter-totter. And so when bonds are up in value, stocks tend to be lower in value. Our expectations for 2014 are an increase in interest rates. Long-term bond yields have tended to track GDP growth in the market, and for 2014, we're not expecting any involvement by the Feds in the market. We don't expect an increase in Fed rates until about the middle of 2015. So our expectation is about a 1% acceleration in GDP growth over the pace of 2013. What that'll do is provide the 10-year Treasury to possibly go from the current rate of 2.75 to possibly up to 3.75 in 2014. So we see a defensive investment posture in the bond market focused on less interest rate sensitive sectors as the most prudent way to invest in 2014. Intermediate bonds are a good bond class to be in with this current market condition. We believe intermediate bonds provide the best risk-reward potential under a large range of outcomes. Long-term bonds, we feel, have too much interest rate risk to be attractive in 2014, while short-term bonds offer less interest rate risk, and their low yields make them much less attractive. Since we feel the Fed won't raise rates until the middle of 2015, and that's supported by our outlook for stronger GDP growth and job growth in 2014, we feel that there'll be a flat, high-quality bond returns in 2014. And with a 0% return or 0% change in bond yields, your total return should still average about 3.4. If interest rates were to rise, we might see a slight decrease in bond values. And if interest rates were to actually go up, we could see a strong return. It is possible for yields could increase by 1 to 3.75 should inflation-adjusted yields return to more levels. Under that scenario, high-quality bond returns would be negative, as indicated by the chart. Interest rate risk remains concentrated among long-term bonds. You can see in this yield curve, the steepest change is from intermediate to long-term bonds. And we always want to be on the steepest part of the yield curve. And again, in this case, it's intermediate bonds. High-yield bonds and bank loans provide a good sector to be in the bond market with the current rising interest rate environment. They've proven historically to produce positive returns during periods of rising interest rates. In 2013, for example, with the rising interest rates, Both were among the leaders in the bond categories. This chart shows intermediate bonds have the ability to generate modestly positive returns despite a fair rise in interest rates. Intermediate bonds can also provide some defensive properties to a portfolio, which we feel is always important. They can produce mid to single digit returns if interest rates are unchanged or even decline slightly. This could be driven by disappointing economic growth or a negative event causing investors to take a temporary defensive stance. In that event, intermediate bonds may provide a positive gain, as you see on the left-hand column, with a 0.25% decrease in yields. And that'll offset the losses in the event of a stock market pullback. High-yield bonds and bank loans are also likely to produce low to mid single-digit returns in 2014. As 2014 progresses, yield spreads may increase as investors begin to demand greater compensation for a potential increase in defaults in 2015. Bank loans may also be impacted by investors bracing for higher defaults, but less than high-yield bonds due to their shorter-term nature and higher seniority. Investment-grade corporate bonds we feel should have better returns than treasury yields. In a rising interest rate environment, interest income can be a buffer against price declines associated with rising interest rates. And again, that's why we feel in corporate high-grade or investment-grade corporate bonds should provide better protection than a treasury in the upcoming year. Municipal bonds are another safer bond category on a long-term basis.
Thank you for watching our 2014 market outlook. If you have any questions about the material that we covered, feel free to call 651-490-2939, 651-490-2939, or visit our website at summitinvest.com. Feel free to contact us anytime if you'd like the investor material that goes along with this workshop. Until we talk again, we hope that you keep on farming and harvesting those great returns in 2014.